Hi, my name's Steve Clapham and welcome to the third in our investing tips series. Here we're going to talk about supply and demand. Investors tend to focus on demand. They talk about the total addressable market, they look at past revenue growth, they ask how much can this company grow its revenue? And those are all great questions to ask. I'm not for a minute suggesting you don't ask them. But they're often very difficult questions to answer. And people tend to pay less attention to the supply side of the equation, to capacity. And it's my belief that supply is often easier to predict and it's often a much more telling component than demand. In my view, if capacity is entering an industry, that tends to be a big issue for me because you've got to get comfort that demand will grow faster than supply. On the other hand, if capacity is leaving an industry, that's usually a surefire signal that you're going to see a much better supply-demand balance, which leads to better pricing, which leads to better profitability. So when I see an industry in which capacity is shrinking, I tend to get very interested because often that's a route to profitability. The transport sector was the sector that I used to cover when I was on the sell side, and the transport sector is particularly susceptible to these small changes in the supply-demand balance. And what I'm showing you here are some slides from Clarkson, which looks at the shipping industry. And the shipping industry, look at this in great detail. And you can see in the chart that the number of global new orders in shipyards had fallen. They collapsed in the late 2010s. In the 2000s, when China started to really grow, it was a boom for the shipping industry and shipping orders went through the roof, particularly bulk shipping because China was importing huge quantities of iron ore. What you can see is that there was post the global financial crisis, there's a big problem in the shipping industry. And all these charts, what you'll see is that the amount of capacity coming into the industry is falling very dramatically. And what does that mean? Well, each year the ships get older and eventually you've got a ship that's really old, you end up having to scrap it. So what you see here, the number of yards with an order book of at least one large ship, down at a very low level. The order book is a percentage of the fleet. This is really important because obviously the charts that I've shown you before were just absolute numbers, but each year the fleet gets larger. So you need more new capacity to replace the ships that need to be scrapped. And you can see here that the order book is a percentage of the fleet at all-time low levels. And this is the really important characteristic. And as a result, what you're seeing is upward pressure on new building prices. So don't forget, spend time looking at demand, but don't forget the supply side of the equation. Supply is often easier to predict than demand, especially when there are lead times. It takes you years to build a ship in some cases. It can take you years to build a cement plant. And supply is often inherently more predictable than demand. So pay very close attention to supply trends. I hope you've enjoyed this video. Please like it. Please subscribe to the channel so you don't miss future videos. Thanks for watching.